You guys ready? FOMC. What's the Fed gonna do? Nah, what are they gonna say? Right? What is the big question for the Fed right now? Currently, so I'm gonna show this on TikTok. I'll try to flip the camera around so you guys can see. On the bottom, you got the FOMC. I'm sorry, you got the 10-year. At the top, you have you should be able to see Powell speaking there. YouTube, what up? I think we have about 7 minutes before we get into it. So we're just sticking around. We'll see. We will definitely take a back seat. Right now, currently, we have the S&P is pretty strong today. Currently pretty strong. Qs are pretty strong. We've had this market rally. Fed tightening financial credit conditions. Here's the big news before we get into it. The conference is coming out. You want to see it? Go ahead and jump over to my Twitter. Also, if you are, let's see. Let me know if you guys can, if the volume is good. Give me a thumbs up if the volume is working. So the Fed paused. We said they were going to pause, right? The big news here is Treasury issuance. Okay, U.S. Treasury has been issuing a lot of debt. That's really no volume. Oh, okay. Hold on. My bad. Tigger Media. Watch. Let me throw this on. Tell me if you hear this.
You get to stick around till the chairman comes on.
Let me know if you can hear that. We're almost there. So Treasury issuance, right? We've had the most U.S. Treasury issuance about. Okay, nice, Tigger Media, appreciate it. We've had $1 trillion. So the U.S. look at the big burden on the market has been higher bond rates. Okay, higher bond rates, moving higher. That's a combination of things, but for the most part, it's been the U.S. fiscal policy, right? Joe Biden, the White House, printing, selling more debt. That dilutes the U.S. Treasury supply. As you dilute the U.S. Treasury supply, bonds go lower, the price of bonds go lower, the rates go higher. That's been the real issue here. So they finally said, okay, we're going to be done issuing treasuries by Q1 of 2024, which is March of 2024. They're going to be done issuing, okay? The issue is they still have a $1.5 trillion of issuance to go. So can the market absorb the $1.5 trillion, or do rates need to go higher? We don't know. We're going to wait, stand by, see how that plays out. Now, the good news today, bond yields peaked. Today, they did peak because they did announce, we've been talking about this, obviously, they did announce that how much issuance they were going to do for Q4, which is October through December, and it was actually lower. It was lighter than expected. So yields peaked. Okay, it was lighter than expected. Yields peaked. They went from... Let's see, where did yields go? Yields went from, right now, just keep in mind, yields peaked the 10-year anyway. We're going to use the benchmark rate at basically 5%. Okay, they hit that for 3 days. You could say they hit it for a fifth day. And now we're at 4.8, 4.78, 4.8%, whatever. So we're down, 0.2 on the bond rates. So the Treasury has pretty much said, hey, they gave some visibility. What up, Fibonacci Poppy? They gave some visibility. We're done. We're going to be done hiking bond rates, basically issuing debt. We'll be done by Q1 of 2024. So March is the end of the issuance. That's what's been plaguing the market. The question is from here to there, and I think markets move into the future. Do bonds sell off, or do rates sell off? Do bonds pick up? And we did have an inflow of bonds. Remember, the bond market right now, typically, if you look at TLT, ticker symbol TLT, that is your proxy to see how much bonds are moving up. So before Powell gets on here to wrap it up, ISM was weak. The ISM manufacturing, okay, that is the forward-looking growth. It came in at 46.7. Okay, that was weak. That's recession territory. Jobs, private payrolls came in weak, recession territory. So bonds have no way, no way to go lower. They should be going higher. Rates should be easing because recessionary fears, or the data for recession, actually increased. Here we go. Oh, okay, no, not yet. We have 2 minutes left. So the point here is, hey, yields have peaked. I'm pretty sure yields have peaked for multiple reasons. Yields have peaked. It's all going to be up to growth. Will growth roll off? Will growth collapse? Earnings are okay. They're not great. They're not terrible. But that's it. And we didn't know the issuance is done. Here goes Powell. And once that issuance is done, where is he at? Is he walking in? Oh, is that the big dog? No, it's not the big dog yet. Almost. He's coming in. He's coming in. So we're gonna listen to what Powell says. Look, the real thing we want to hear, what you want to pay attention to for this meeting, does he signal another hike in December? Does he just stay hawkish because he says he's gonna be hawkish, or does he actually say, hey, you know what, we're pretty much done here. We're gonna stay hawkish. We're data dependent. If they're data dependent, the market can see through it. Because data dependent means we just got to look at the employment data coming in on Friday. We just got to look at the next month's data. Oil, look at, here's the big upside. Oil is light. Oil prices are at what? They're falling. Everybody expected $100 oil. We're at 80, bro. That means the next inflation print's going to be headline at least is going to be lower. So headline is set to fall. The war is not is not picking up in a significant way yet. So expect oil. I expect that next inflation print to be very positive. The market, I think this is the Santa Claus rally. What did I say? By November, we should be moving higher. Okay? By November, we should. And listen, we're getting the highest inflow of bonds in history. I'll show that chart later after the meeting. The highest inflow of bonds, which means rates are due to collapse, right? Rates are due to collapse. And of course, he's going to stay hawkish. He's probably going to have a hawkish pause, but I still think he's possibly going to be more dovish versus the last meetings. Dovish and hawkish is always debatable, but I think it has more to do with the previous meetings. Is he a little more dovish? Here he is. Let's go.
Previously, Here comes the Chair Powell. So why don't we interact? Paul, great to be with you.
Great to be with you. Thank you.
Here comes the chair.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year. particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Go to Howard.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices, could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. Things are fluctuating back and forth. That's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us that we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And, the mind's eye goes to the 8%, near 8% mortgage rate, which could have, pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't, but we're not confident that we have. And that is the way we're going to be going into these future meetings, is to be, just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into the December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a 1/4 point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see. If you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our two mandate goals. We look at that. And we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for, I'm sorry, 1 additional hike?
I think you're
this
talking
year?
about one additional.
Yeah,
I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question. And you're right that in September, we wrote down 1 additional rate hike, but, and we'll write down another forecast, as you know, in December.
Thank you. Chris Rugaber at Associated Press. Since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation. And we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even. Just thinking that we really, the best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. You know, we've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left. We think, and I think, we'll still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
I'm curious against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change, for example. I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential, and that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think one or two additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So, committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up. And QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Janelle Marte with Bloomberg. So in addition to persistence, when you look at long-term Treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy? and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term Treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture. And they do play a role, of course, in many of the major standard financial condition indexes. Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the 2s, and the year after that further into the 2s. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, And so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks are, have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether our star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, and ultimately we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, wage increases have really come down significantly over the course of the last 18 months. to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back it comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally, too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although that we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is clear, I think, clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is, well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think that's what we want to see, that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong, and So a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point, we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. That took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So Daniel, the last question.
Thank you, Chair Powell. Daniel Avis from Agence France-Presse. Just a quick question following up on an earlier one. With regards to the Israel-Hamas conflict, the Fed's financial stability report said that Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take great, really important notice of. But it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
Welcome to Closing Bell. I'm Scott Wapner here at the New York Stock Exchange. That was Fed Chair Powell after the second pause meeting in a row. No hiking of interest rates, exactly what the market was expecting, of course, with the real question heading into today, what comes next? In terms of, on that note, the statement was very similar to the past one, which led to the pause. Chair Powell saying inflation has moderated but remains well above the target of 2%. Getting there, quote, in his words, has a long way to go, economy expanding at a strong pace, above expectations, but that the full effect of policy tightening has yet to be felt. Said they'll proceed carefully, said that at least a few times. We'll make meeting by meeting decisions. We'll have Jeffrey Gunlock, of course, of Double Line, as we always do, exclusively coming up in just a moment. In the meantime, let's bring in Josh Brown of Ritholtz Wealth Management. He's also a CNBC contributor here with us on set. Nice move in stocks. Nice drop in yields. You think that's on the idea that they're done?
Yeah, I think the reaction in stocks started off as muted. There's actually only one sector that's in the red right now. Outperforming sectors are a little bit of a mixed bag. I can't really tell a great story about this. Maybe Santoli can come up with it. Tech, utilities, communications, all up more than 1%. I think a lot of what we're seeing here, though, is just the fact that there is no new news. Art Cashin had a note out relatively quickly once we all saw the statement. He mentions the fact that even the periods and the commas are in the same place. There's not a lot here, and in the absence of not a lot, markets can rally. It's one less thing that we have to worry about, and I think that was really key. Last thing I would mention, all of the action, the meaningful action, let's say, is in the belly of the curve. The 2, the 3, the 5, and 7-year Treasury all have down double digits, but when you look at the short end, it's flat. You look at the long end, it's flat. I thought that was maybe somewhat notable. What's the reason behind that? I asked my research team. They said positioning and hung up on me.
Yeah, the 10-year note, just look at it at 477. That really came down today with the Treasury refunding announcement. Some of the economic data was weaker. We'll ask the legendary bond investor Jeffrey Gundlach about all of that. He does join us right now exclusively to react, the CEO, CIO, co-founder of Double Line Capital. Jeffrey, it's a pleasure to have you here on Fed Day as always.
Yes, Judge, it's good to be back for Fed Day. Not a lot of, Josh is right.
Okay, sorry about you, YouTube. I was talking to TikTok anyway. So the Fed is done. The Fed is done. We called this out yesterday. Okay, let's take a look at the channel content. Okay, I'm gonna keep it like this. If you guys want to see the charts, we're gonna go over the charts. Go ahead and jump onto YouTube, right? And a lot of your answers will be answered on TikTok. Go look at my videos that I made. The next 3 days, the most important part of the market. Rates are likely done. Okay, it's going to come down to Apple earnings, which we have tomorrow. The employment report on Friday, which you want to see is, what is the Fed done hiking? What does that mean? It means the Fed has no reason to hike. The data points to the Fed is done. Okay, inflation is coming down. If you want to debate me on that, go ahead. We can do that, right? So the Fed is done. Inflation is coming down. Let's go get that straightened out. Make sure that, why does this look weird? Anyways, we're on YouTube if you want to see the charts. I'll go through you guys' comments. Some people are saying the U.S., really quick, the U.S. is in trouble. Let me throw the charts on while we're looking. The U.S. dollar is in trouble if the debt doesn't get, this is all political, right? The whole fiscal stimulus is political. Nobody's worried about the U.S. debt being too high. Are you kidding me? The U.S. debt, it always goes higher. That's not the issue. The issue is how you spend it. That's what Republicans and Democrats argue about and fight about, how you spend the money. You think Republicans are going to spend less? You got to be joking. It is all political. They're going to spend the same. It all comes down to how you spend it. Obviously, some parts don't want to spend in Ukraine. Others don't want to spend, on COVID this. I don't know what I can say without getting banned, but they don't want to spend in certain areas. It's all about how you spend the money. It's not total debt. Total debt always goes up. The Fed's balance sheet always goes up. Those interest payments will be on the Fed's balance sheet eventually. Okay. Anyways, let's get to the charts here. We got some bullish price action. And again, for you guys on the dollar, I had to make a couple more charts here. For you guys on the dollar over there, arguing about how the dollar moves, let me just tell you that most of the transactions in the world are done on the dollar. Okay, it's actually been rising over the past, we got to get this up. It's actually been rising over the past like 6 months to a year. The dollar usage is actually rising. It's more significant. 80% of global debt is in US dollars. You want to not pay back your debts, guess what? The dollar goes higher because you default and the collateral goes up. The dollar becomes more scarce. So that argument is silly. There's a lot of politics you guys are listening to. You have recency bias. Look at 08. Look at 2001. When you have a black swan event, that's when things collapse. Until you get a black swan, the market goes higher because the Fed orchestrates financial is going to orchestrate some type of financial engineering to make sure the debt gets paid off on the Fed's balance sheet. Watch the Fed's balance sheet, right? They have shadow QE. That's been going on for a while. If you're unfamiliar, stay tuned on the content. We talk about this pretty much every day, 5 days a week. Okay, if you want to see what's really going on in the market, we call the bottom of crypto going higher. There's a lot of stuff in the workings right now. We said, hey, the market will bounce on a technical basis. Look at the Qs ripping right back up. Now, the next question is, do we get past 360? Okay. How much is the Biden admin and Soros paying you? Oh, gosh, we got some Biden. Bro, this is hilarious. The funny thing is, I'm a Trump fan, but I just call out the facts how they are, right? I'm not a Biden fan. Are you kidding me? First of all, Biden's not even he's not really there. Let's keep it real. He's not really there. The thing is, facts are facts. You guys want to get stuck up on politics? It means nothing. Politics means nothing, bro. The market is the market. You guys get so stuck into politics. Stop viewing the world when it comes to this. If you want to talk about politics, this is not a political channel. This is financial, stock market, equities, macroeconomic. This is data. If you're one of those guys who says, I believe no data, I don't believe any of the data, well, then what the hell do you believe? That's always the argument. Oh, well, how do you calculate inflation? We're looking at the actual labor statistics. We're actually looking at the real data. If you don't believe the real data, then what the hell do you believe? What are you working off? The market, we're talking about the stock market here. We're talking about the crypto markets here, the bond market. It actually moves off data. It doesn't move off of your made up statistics based off of some dude, and I'm an Alex Jones fan, but based off some dude, some random dude just saying, oh, look at this, right? That's not how it works. So how do I calculate? There's a lot of inflation. There's CPI. There's headline CPI. There's the Fed's preferred inflation gauge, PCE. There is core inflation. There's super core inflation. There's all kinds of ways to measure inflation. Inflation is falling on the core basis. What the Fed is the one that the Fed's looking at, it is falling. Again, I will debate you guys live. The thing is, people say things, and that's totally fine. I'll adjust to your comments, but you'll never debate live because you can't really back up what you're saying. You're just hearing it. Maybe some people can. You're just hearing it, and then you're just regurgitating what you heard, but you don't even know what it really means. Okay. Anyways, your audio's off. What do you even say to think you're a Biden fan? Oh, just because I don't even know why they think I'm a Biden fan. That is hilarious. Listen, my mom is a big Trump's fan. I love my mom, but anything that points anything that actually points to Biden administration, because not him really, doing something positive or the economy is strong. Oh my God, you love Biden. Bro, it is the data. Get off your political high horse. It's irrelevant. Okay, right now the economy is actually being saved by the Inflation Reduction Act, the CHIPS Act, the infrastructure bill. Without that, we would have collapsed. We would have went into recession. That is true. So that's actually helping here. Has nothing to do with, you think Trump wouldn't have printed money? You got to be out of your damn mind. He just prints money, in my view, more efficiently, right? He's going to do it more productive, more efficiently, but that has nothing to do with the fact that a positive is a positive for the market, okay? Get off your political high horse. You guys are stuck in 1985 or 1962. It has nothing to do with politics. It has to do with the damn facts. Oil is not going higher right now. We're looking at the oil charts. We're on YouTube. Why is oil not going higher? Because the U.S. is the biggest producer of oil. And guess what? We're at a record high producing oil. Also, the supply, okay? No, I'm sorry, we're supplying the most oil, but the demand is coming down. The demand is also coming down. Okay, U.S. demand, you want to see the damn charts? Go on YouTube. I have them on here all the time. U.S. demand is coming down. So the biggest consumer is consuming less oil. The biggest producer is producing more. Okay, it has nothing to do with being a Biden fan. That is the damn market. The market determines the price of oil, not who's in administration. That is hilarious. That's not how it works. You guys are confused if you think that. You're being fooled, or you just don't know what the hell you're talking about. So anyways, if you want to debate me, go ahead. There's 200 of you. You guys want to debate me, go ahead and debate me, whatever it is. Okay, YouTube, you guys know how it is. We're going to look at the charts, but I'm going to go ahead and let these TikTok guys talk because I don't even know what they're talking about most of the time. If they do, I do give you credit for that. All right, let's address some of these. Okay, if you guys are on YouTube, I'm going to go to these guys. There's a lot of them watching. How much is Biden paying you? Okay, whatever. How do you calculate inflation? Bro, get out of here. Which inflation calculation are you espousing? We're looking at the government data. Okay, we're looking at the government data. CPI, PCE, preferred inflation gauge. So you making up some new data? Politicians don't affect debt and inflation with reckless policies and spending. Yeah, okay. No, they do. They do affect, listen, it's how you spend the debt. The government will always create more money. They're always going to do it. This is the system we live in. This is the reality. The question is, how do they spend the money? Is it productive to the economy, or is it non-productive? If you give stimulus checks to people straight to their hands, they're producing nothing and they're spending it. That's inflationary. If you're putting it into manufacturing, certain types of investments, and it's actually producing more, it's creating more productivity, inflation doesn't go higher. So those are just economic dynamics. Demiyush, if you had a real small, mid-sized business, you would talk differently. You make money from hype. Okay. Nah, you're just, oh yeah, you're right. Small businesses, I don't even know what you're talking about. Small businesses are in trouble because small businesses, there's actually a chart that came out. They're dealing with higher rates right now. They have to deal with the higher rates. Bigger businesses like S&P don't, because money market funds are yielding you 5%. So they have the cash to park it in money market funds, number one. Number two, they locked in rates lower. They don't have to refi their rates as much, as recent, right? As frequent. So that's how it works. Dima Yush, anyways, yeah, you're on hype. Well, we'll see crypto. We'll see how much crypto goes up. I guess that's the hype. Crypto is going to explode. You're just trying to help people educate financial recovery. Yeah, I'm just trying to educate you, bro. That's it. If you, like I said, if you want to debate, I'll go live with you. You will say something on here, but you'll never go live. You're never going to go face to face. I like to debate. I like to argue. And if I'm wrong about something. I do it all the time. But for the most part, it's easy to say stuff behind a picture. Republicans control energy sector, adverse effect on the market. Republicans control the energy sector. I mean, I don't really know how that works or what theory that is. Shut down Keystone. We no longer are a larger producer. You're 100% bought and paid for. Bro, yeah, you're right. The Keystone pipeline was a bad move for Biden. That was a terrible move. We should have been producing more. But we are still, look at the data, bro. Vladimir sees you, bro. Look at the data. You probably have no data. You probably don't even know where to look. Here, if you're on YouTube, you guys have already seen this. I'm gonna throw the data up because they're trying to say, or this guy Vladimir is trying to say that that we're not the biggest producer. Look, dude, use common sense. The U.S., okay, and look up the data. The U.S. is the biggest producer of oil in the world, #1. Okay, we're also the biggest consumer of oil. Use facts, bro, not how you feel, not what you just read in some fear-mongering article. Oil is, the U.S. is the biggest producer, period. Now, could we have produced better, more efficiently? Yes, 100%. But we're still the biggest. You're not gonna deny. I mean, you can't disprove that. That's a fact, right? Shutting down the pipeline was a mistake for sure. And I'm not a Biden supporter, bro. It's just a fact. If Trump would have done it, it would have been an issue too. It doesn't matter. Like I said, the politics are irrelevant. They do impact the market to some degree, though. You think we rally for the rest of the week? Well, look we still have, here's the thing, the ISM, and we're going to go over this data if you're on YouTube, the ISM, let me just get through these TikTokers over here who just say random stuff with no face. The ISM survey is the manufacturing sector that actually went recessionary today, right? So that went to 46.7, which is very recessionary. And that's why bond yields are also easing at the same time. So it's signaling, hey, the fourth quarter is weaker than the third quarter. Right? So that's what we're looking at right now. Can the market go higher after that? If 10-year yields, if yields start to ease, and right now yields are easing. Let's go to the 1 day. Yeah, yields are starting to ease. Here we go. Yields are easing. So yields are breaking down. We just made a low from October 20th. So as long as yields ease, the market can rally is what I'll say. We have employment on Friday. We have Apple earnings. I think the market is actually selling off in earnings, and then they're going to buy up when they end, whenever we end. So I think we still have a Santa Claus rally, maybe not to all-time highs, which I did talk about before. Are you a full-time trader or are you an influencer? I'm not an influencer. I just talk about what I do. I trade options. I swing trade more than anything. I don't do day trading. I swing trade. And I am, I guess you could say influencer, but I think that's a silly term. I don't really use influencer. Like I said, I'll say this. I'll debate you, whoever you are, if you want to know. Wrong. Some policies like what Biden emptied the backups for lower prices. Now it will. Yeah. Oh, that's another thing. Okay. Biden, emptied the SPR. That was smart. Okay, I don't care what your political view is. That was smart. He emptied the SPR to get more supply online to make sure oil prices were suppressed, because his biggest lever is is inflation. That's his biggest issue. So his biggest lever is to put more money in people's pockets to get prices down, which is why they're probably going to print more even if the economy slows in 2024. Because simply put, that's what politicians do when they need help. They give more stimulus, right? That's inflationary. We'll see. So yeah, he lowered the SPR. He also eased sanctions on Iran initially, and that caused more supply. He also eased sanctions on Venezuela recently to get more supply. So is it he? Is it Biden? Get the word Biden out of your mouth. It's irrelevant. It's whoever's in control. They're going to do what they can. You guys think they want to crash the economy? No, they want to do what they can. They need a strong economy. The U.S. doesn't work without it. They might make stupid decisions, though, that's for sure. What if they put it in Ukraine and 10% of the big guy? I don't even know what you're saying, bro. Talk correctly. Write something that's readable. What if they put it into Ukraine? Or why is that showing up again? Does that cause inflation? The more you invest in Ukraine, you are creating more productivity in the U.S. in manufacturing and industrial. So the money goes to the industrial companies, obviously. And if the supply lags on food and other things, yeah, it's going to be a little bit inflationary to some degree. It's not the biggest. People are working. As long as people have jobs and they can keep creating more output, you're not going to get that much inflation, right? Obviously, we're not getting it. Look at core inflation. It is not rising on a year-over-year basis. It's falling. The only way you get more inflation is if oil starts to spike above 100%. That's the only way. We're not getting that. Above $100, my bad. What if they put into Ukraine? Bro, why does that say, why do you keep repeating the same thing? Okay, you just want me to address it. Yeah, anyways. The pipeline was a bad move for Biden. Yeah, 100%. XRP quant are revolutionary. I'm sorry, XRP Queen. XRP just got smoked by Chainlink because the use case is no longer really relevant. XRP just lost 90% of the use case. XRP is actually older than Ethereum. XRP, their whole premise is based on central banks will come and they will use the XRP ledger. They're not using it. They're not going to use XRP ledger. They've already shown me one article where central banks are using XRP ledger. They're not. They're using Chainlink CCIP because they want their own blockchains. They want to use their own blockchains, their own private blockchains, and transact between other blockchains. They're not going to use XRP. You might find one little institution, but most of them are using CCIP. Swift is DTCC, which is the biggest depository transactor for the U.S. Settlement layer. They're all using Chainlink. So XRP, hey, people love XRP. It's cool. I don't care. I hope it goes higher. I don't really care. But the use case is not really great. The use case is falling apart for XRP. Bribes from China, Ukraine, Mexico. Bro, we're not talking about bribes. We're talking about the market here. That's irrelevant. This is not a political channel. I guess it can leak in there a little bit. The pipeline was not an operant. Its cancellation had... Dude, I can't even read what you're saying. Had no effect on our gas. Anyways, yeah, the big issue for that was basically if you don't produce more oil, then you give leverage to the nations like Russia to do anything they want to do because now they can spike the oil price. So it's all politics. Look, other countries want to get off the US dollar for sure. They're going to try to get the US to keep spending money as much as they can, to keep expanding the deficit, to somehow crack our economy. The problem is we have the biggest central bank in the world and we can just buy all the debt through the central bank. It sounds simple, but that's just how it's worked. What is the relationship between a bond price and its interest rates? They're literally inverse. Stack and rack. They are inverse. So they're inverse. If bonds go up, rates come down. Bonds go down, rates go up. That's why we're in this mess right now. The Fed is doing QT. What the hell are you talking about? It depends how you define QT, AJ. Is QT all money being sucked out of the system? If that's the case, it's not QT because there's shadow liquidity coming into the market. The reverse repo facility, you should know this if you're going to talk about the Fed and QT. The reverse repo facility got up to $2.5 trillion. That's parked at the Fed where they pay interest, which is the Fed funds rate. All that money, right now there's $1 trillion that came off the Fed's reverse repo facility back into capital markets. So really the Fed is actually buying short-term treasuries. That's who's buying them. So the Fed is still in QE to some degree. They're not in full QE, right? Because the balance sheet's still being shaved off. What happened during the banking crisis? When the When SVB collapsed, when the banking crisis came, what happened? The Fed's balance sheet went up. Okay, it actually went up. So AJ, I'll debate you too. If you guys just have to have 1,000 followers, that's the only thing that sucks. I wish you didn't have to do that. But yeah, I'll debate you guys. We're more so in QT for sure, but the markets look ahead, right? The markets are sniffing out the end of QT, and it's all about rate of change. There's a lot of cash on the sideline. So either way, yeah, you have shadow QE coming into the market. That is why it's not full QT. It's just not full QT. You have shadow QE. We're getting insane inflation. What are you talking about? Where? Jay Brock, where's the insane inflation coming from? Where is it coming from? Where's the insane inflation? The rate of inflation is not prices where they are versus 2 years ago. Inflation is the rate of change month over month, year over year. That's what inflation is. So it is at a 20% compounded interest versus 2020. So prices are up in general 20% versus 2020. But for the stock market, the way markets work, they look at the rate of change on a month-over-month basis and over year-over-year basis, and those have all been falling. Month-over-month's a little more volatile. But for the most part, core CPI, what the Fed focuses on, core CPI is not going higher. We just talked about this yesterday from a couple people. Okay? Let's see. Insane inflation, bro. What are you talking about? Will you be going live for Apple earnings? Yes, I will. I'll be live for Apple earnings. That's tomorrow, right? Yeah. Well, look, because Apple's the biggest stock in the market. That's what we got to look at. You said inflation wasn't high. You definitely lost me there. Inflation wasn't high. The rate of change, Jay Brock, the rate of change of inflation is not accelerating. It is not accelerating. It's decelerating, right? Not as fast as people would hope, but it's actually decelerating. And now that oil went from 90 this month in October, from 90 and ended the month at 80, that inflation rate is going to be even lower going into the next print. Housing inflation coming down, rent inflation coming down, vehicle inflation coming down. You guys probably just hear headlines on the news and then recapitulate that. Link flips ETH. Ooh, okay. I see you, K-Fish, with the Link. Yeah, Link. I'm big on Link. I'm the most bullish on Link. I think they do the most for sure. I'm very bullish on Chainlink. Know nothing about the market. Have 300. I could invest. Where do I start? Oh, you know nothing. I would say educate yourself first. Come on the lives. I have a YouTube. Go check out the YouTube. Subscribe. I have a lot of stuff that I write about. Ask questions on the YouTube. But for the most part, like if you don't need that $300, your best bet is you're gonna make the most money in crypto in this next cycle. It's not even close. You're gonna make the most money in crypto. Don't go buy a bunch of crap coins though. Bitcoin is your safest. Ethereum, and I would say Chainlink. Right? No, not financial advice. I'm not giving financial advice, but where we are in the cycle, crypto's going to be the most explosive asset class. Okay, all the data points to that. I mean, it's not really debatable at this point. Bitcoin is the best performing asset this year. It's up 100%. It's the best performing asset in the last 10 years. It's not even close. Okay, and that's just Bitcoin. But most of them are scams. 99% are scams. I would say educate yourself, stay on the lives, ask questions, educate yourself more than anything before you start investing. Who else is going to buy all these new issued bonds? Fresh. So who's going to buy the issued bonds? I know you guys have comments on YouTube here. We're just watching the 10-year treasury sink and the market start to love it. Let's see. QT, XRP's been making lower lows since 2017. Yeah, XRP's it's kind of old news. XRP's just old. It doesn't have the new features that the tokenization narrative. They don't have the features to tokenize the world. They just don't. It's an old legacy system. Solana, I would be way more bullish on Solana than XRP. So who's going to buy the issued bond? That's a great question. Here's Josh. What up, Josh? Inflation is slowing, but consumer spending is still fueling GDP and inflation stabilizing. Yeah. Well, yeah, true. So consumers spend a lot. Third quarter GDP was pretty elevated, but the fourth quarter GDP is annualized. Is set to be at 2.3%. Third quarter was at 4.9%. So GDP for the fourth quarter is actually lower than what it was in the third quarter. Number one. Number two, I think consumers are starting to feel it now. So I don't really see inflation ramping up unless oil really starts to spike again. I mean, we'll see. We'll get the numbers out. We'll see the numbers, but I'll stick with the data. I'll just stick with the data. Inflation is not collapsing, but it's not re-accelerating right? The way people believe it is. There's a lot of ways to measure it, so people get confused, and there's a lot of ways that it's not reaccelerating in general. So who's going to buy the issued bonds? That is a good question. Right now, we have the record bond inflows. Consumer households are buying a lot of bonds. It's probably mostly rich people because they're going to yield a lot off of it. And there's a couple charts I'm going to show them. Stay tuned with the content where bond inflows are actually at the highest level they've ever been. The problem is there's a lot of people shorting bonds because as the Treasury issues new bonds, well, that pushes selling pressure, that increases selling pressure, so they're shorting it. But Bill Ackman just covered the bond market. I mean, the yields are not responding to hotter data. We talked about this the other day. Treasury issuance that we got this morning was actually lighter than expected, so bonds sold off. I mean, not bonds bid up and rates came down. And they're gonna be done issuing in Q1 of 2024. They're done issuing in Q1 of 2024. That's the backdrop. So yeah, there's still a lot of issuance out there. Rates will probably remain elevated. I think they're done going up for this year. They could go back up to 5%, but I think they're done spiking unless there's some type of black swan. I don't know what it's going to be, but if growth collapses, bonds come down even further. And the Fed can always reverse. What does Apple have that makes it attractive to go long? I'm not interested in going long Apple. Okay, Apple's a rich man's stock. It's a safe stock for sure. Like, you want to buy Apple when it gets destroyed. It's the biggest stock in the market. I mean, you guys, Apple's the new quality. It's a new flight to quality. Let's look at Apple. Apple's really going to determine the APL, what happens in the market going forward. It's forming a really bullish flag pattern. This is a very bullish flag pattern right here. Okay, so Apple is forming a bullish flag pattern. Hey, and some of you guys that are on here, if you want to come in and talk smack during the live, I really don't mind. I'd rather you jump on YouTube make a fool of yourself on YouTube. That'd be more interesting because it gets lost in the feed. So if you want to talk smack or challenge me, whatever, that's perfectly fine. I'm not gonna flag you or anything. I really don't care. I think it's good to have, conflicting views so that people can hear the explanations. We want to hear the logic, the reasoning, the data, the actual, reasoning behind your view, not just some random outburst of, oh, the market's going lower, the market's going higher, the Fed is this, the Fed is that. Give an explanation, which is why I said I'll go live with you. Anyways, all these trolls you have, they're mad because they buy in penny stocks. Dude, don't buy penny stocks. They're trash, number one. And I think a lot of people they want the market to crash because they're reading fear mongering all over and they want the market to crash so they can buy lower. And, it could happen, but I think you need a black swan. I just don't see the market falling. There's too many forces that point to recovery. Market psychology kills people. Why? Because typically all the bad news is already priced in. Most of the bad news is priced in. Without the war, the market would be probably at the highs or all-time highs right now without the war. But that's a lot of uncertainty, right? Rising rates are the biggest issue, but if they have peaked, I think we have a end of the year rally, Santa Claus rally. Does it go to all-time highs? I don't know. I'm a little less optimistic about all-time highs now because a lot of new risks have hit the market. But again, there's a lot of upside too. ISM falling is kind of signaling, hey, growth is not as strong. That's why, Josh, I would say that I don't see inflation because the ISM now is pointing to less growth. Oh, stagflation is the next thing. Oh, we're going to have stagflation. Where's the stagflation? I mean, you guys might point out one exception, but in general, macro is you take all the macro together in context to the S&P or in context to the stock market. And no, Apple's actually decreasing their prices. Tesla's actually decreasing their prices on the newer models. That's deflationary. That's actually deflationary. So we'll see how it plays out. Consumers are spending higher, though. They just keep spending. They're going to be out of money by January, February, likely, but employment remains strong. And if the top 10% keep spending because they have all the money, well, I mean, there's still going to be more jobs. People just keep spending. I don't see recession. What do we have here? 10x on Solana. Okay. Solana will probably go higher. I don't have issue with Solana, even though I think down the road, Ethereum basically becomes Ethereum's can actually take a lot of the narrative from Solana because it's just slower right now. But we'll see how that plays out. Things change really quickly in crypto. Would you say you just get stuck in it? Discourse is always good, even when it is opposition. Yeah, discourse is perfect. You want opposing discourse, 100%. You want opposing discourse. You're not going to agree with everybody. I'm not going to force feed you and try to say, oh, you're wrong, just because. I'm just going to prove to you why you're wrong. All the data, all the charts, whatever it is. And, it's all about that. It's all about better discourse, not trashing nobody. It's just better discourse. I'll make fun of you if you say something stupid, though. That's for sure. The days of getting the newest iPhone are over. Apple stock is going down. See, that's one of those things. The days of getting the newest iPhone are over. Apple stock is going down. That right there. I mean, what do you mean in the short run, the next 2 days, the next 5 days, the next 10 days, the next year? Apple stock's not going down. They can buy back their own stock. They're going to increase EPS automatically. They make the share. They basically can increase their dividends. Apple stock is not going down. It could go down in a day, 2 days, a week, a month. But overall, Apple stock is not going anywhere. It's not going to sink and lose a bunch of market share. They have Apple services. There's a lot of investment. There's a lot of things behind the hood. The MacBook Pro just came out, the new one. Are iPhones pretty much done with the growth phase? I do agree with that. I think the iPhone growth phase is done. That doesn't mean Apple stock overall is going to sink to, I don't know what you think it's going to sink to. Jamie Dimon historically calls for fear while buying stocks and investing. Yep. Jamie Dimon, 7% interest rates. Bitcoin is a scam. And he's over there buying Bitcoin, over there investing. Like, yeah, you're right. You're right. The markets, people get pissed at the markets because they hear all this stuff and then the market does the opposite and they're pissed. And that's why I'm here to show you or I don't have to prove it to you, but provide you another opinion, another alternative to think twice. Okay. To think it through and then make your choice, not just tell you what you should do. You should do this. You should do that. I'll tell you what I think, but for the most part, and we're going to get to the data here. I just wanted to address all these TikToker guys. Not all of you on TikTok are, there's a smart people on TikTok, Josh, some of you guys that I know, but most of you, okay, maybe not all of you on now, but a lot of people jump on, they just say random bullshit, just random stuff. I don't know what it's for, but I will debate them. They won't jump on. They're not going to debate. If you do, all right, Dylan Greenlee, if you do want to debate, message me. We'll literally debate live. But again, you're probably not going to do it. Okay, so let's get to the content. All right, let's get to the content now. If you want to jump on, look at the technicals. We're on YouTube. We do the macro. We do the technicals. We do the fundamentals. Right now, earnings are looking pretty nice. Look at AMD yesterday. We had AMD sell-off pre-market, exploded. Now, is it out of this big, pattern? No, it's not. It's still in the... See, how can I make this bigger? It's still in this falling flag pattern, okay? But that was a big move. Let's look at the volume here. That was some pretty nice volume for AMD. So AMD's picking up. I think NVIDIA's picking up. Let's start with the indexes, though. Let's go ahead and start with the indexes, all right? So S&P is now back into the uptrend, okay? It bottomed. Now, I found there's a gap down here that it filled. It got very close to filling the gap. So S&P's back up, right? It just jumped what? Over the last couple of days, we called the bottom. We said, hey, it's oversold. That's why we use technicals we use the technicals to layer on the macro. We use the macro, the technicals, and the fundamentals. Right now, earnings are still solid. They're leaving the earnings recession. They're actually improving. Earnings are not falling apart. They're falling apart for the bottom half of companies that suck, right? That can't deal with higher rates. But most of the market is moved by the Mag 7. Fortunately or unfortunately, depending on how you invest. So market's oversold. We got a double oversold signal. Now it is bouncing. The question is, can it continue higher? We will see on Apple earnings if it's by the news. And also, here's the big part, guys. We talked about this yesterday. Here's the big part. I'll get you guys on YouTube. I just wanted to rant here. Mutual funds are $32 trillion industry. A $32 trillion industry. You know who owns them? State Street, Morgan Stanley, Charles Schwab. The biggest asset managers on the world own the mutual funds. All the losses that they had, okay, their fiscal year ends in October. All the losses that they had, they can tax loss harvest those, meaning they're going to keep selling all their losers so that they can get benefits on their taxes. And then once October is done, which was yesterday, look at my videos, we talked about this, boom, now they can start buying. Did they go all in today? No. But the selling pressure pretty much decelerates. There's not a whole lot of selling pressure anymore. You need a bigger catalyst, right? So now the market bounced, right? Now the market is really bouncy, starting to pick up some momentum. The Fed is pretty dovish. They're done hiking. Yields are going to pretty much hike for the Fed. They are coming down at the moment. I don't see a December hike. Maybe something changes. But like I said, GDP is actually lower than the previous quarter. It's not accelerating, right? And growth is not falling apart. So we're straight here. You got China printing, you got Japan printing, Chinese PMIs, which is their manufacturing cycle, their economic activity came out weak, which means what? More cowbell, more stimulus. They're going to keep printing money, which really does great for crypto, because crypto is going to collect all the risk, all the money. Crypto moves when global liquidity picks up. When central banks debase their currency, crypto swallows the liquidity and goes higher. Period. Biggs, they want a deep dip to buy so they want the crash. Yeah, they want a big dip because they want the crash. I don't see it though. I remember everybody calling for 10K Bitcoin. Yep, everybody 10K Bitcoin, and they never got it. Typically, the bottom is when people hate it the most. Crypto bottoms and peaks before markets. It's a forward-looking. Crypto peaked in 2021 when the Fed announced they would start hiking in the next year. It peaked on the announcement, not the actual hikes. So it's going to bottom beforehand, not the actual, it's going to bottom before the stock market. So crypto, the bottom was in a long time ago, unless you get a black swan event, as I said. Now it's at 34K. They missed some good entries. Now they want it lower. Yeah, that's how markets work. There's no promise. There is no perfect formula for markets. If anybody tells you, I will teach you how to be the perfect trader, the perfect investor, it doesn't exist. It doesn't exist. The markets change all the time. They're changing as we speak. The Fed is speaking more than they ever have in history. They're communicating ahead of time what they're going to do. And the market is now digesting it right away and then moving forward. This is not 08. There's not a financial crisis. We have quantitative easing. We didn't have that in 08. That was the birth of QE. Now we have QE. So now the Fed will actually save markets when they can. They just did it in March. They're going to save markets. What's the downside? The downside is prices go higher. But you know what else goes higher? Asset prices. That's where you benefit. Asset prices. If you had Bitcoin as a savings account in 2020 when everything collapsed, well, Bitcoin got down to 3,400. It's up 10x. And it's at the lows. It's down 50% from the highs and still 10x up from the lows. That's what inflates the most, asset prices. That's where you beat the Fed, asset prices, or you start a business, but that's really hard. It's way easier to invest than to start a business and be profitable, right? So that's what's going on there. Anyways, why HYG at such a high return of 9%? Very good question. Financial engineering. It's a high, it's a high liquid. I don't know. That's a really good question. I actually wondered that myself. I'm like, how the hell did they get 9% return? It's a bunch of financial engineering, Tigger Media. But again, if you want to stay safe, which I don't think it's the time to stay safe for me personally, the way I'd look at the market. If you want to be safe, HYG is yielding 9% interest. Okay, the underlying collateral doesn't move that much. It barely moves. TLT, I mean, those are bonds. The government's not going to collapse on their debt. As much as you guys like to push that, or somebody's pushing it to you, the government's going to collapse on they're not going to be able to pay their debt. Yes, they will. The government is not in this lifetime. Maybe some other time, maybe in 100 years. But as of now, we have the strongest military. We have the strongest central bank. We have the strongest economy. Why the hell would we not be able to pay back the debt? Number two, even you guys in the chat, you want to hold Russian rubles? You want to hold Chinese yuan? You want to hold Japanese yen? No, you don't. You don't want to hold Middle Eastern currency. At the end of the day, people want dollars. They want US dollars. That's how they run their businesses. They don't want these other currencies. They're too volatile, and those central banks collapse the most, the fastest, all the time. So dollar's going nowhere, number one. Okay, it's not going anywhere anytime soon. Once it goes up a lot, it could collapse, but other currencies will collapse also because they're going to keep printing. I know I'm off on a tangent there. So that's what we're looking at. S&P is starting to bounce. Pretty good news. Now look, we could sell off and go down. We're just showing the fact that the more important piece here, the dollar just had a big capitulation. Okay, it is showing some bearish divergence. Okay, we'll see if the dollar actually collapses. Rates have been driving the dollar higher. When I say rates, I'm talking about bond yields. And look at bond yields. They are now showing a breakdown. Okay, it could bounce where it's not over yet, but bonds are starting to break down. This is the 10-year yield. Okay, look at that big red candle after the Fed meeting. The Fed is done. The Fed is done. Mark my words. I could be wrong. I'm not saying I couldn't be wrong because something could change. But as of now, looking forward, paribus unis, everything held equal, the Fed is done. Okay. Another big piece to the macro that is very positive. Look at oil. Oil is starting to break down. It's almost at the lows at $80. Why? Because the U.S. is the biggest consumer. They're consuming less. The U.S. is the biggest producer. They're producing more. Okay. So could somebody offset that? Sure. But right now, oil prices are falling. Okay. And that means the next inflation headline print is going to be lower. I think so. Right. I don't know. Like I said, I'm not here to tell you what the, what that my opinion is fact. It is not. It is just, I'm taking everything together and trying to give another view on the market. But oil looks like it's rolling over. It could bounce here. We'll see how it plays out. You need the war to really accelerate and expand. And it looks like it's not. It doesn't. Oil prices would spike if they believe the war was expanding. That's just not the case at the moment. Look at the VIX. The VIX is at 16. Okay, the VIX is right back down. Right, the risks are off the table. Everybody think the risks of recession are not there. I know some of you disagree with me. I get it. I don't see the risk of recession being here yet. We're gonna get those employment numbers on Friday. You need employment to fall apart, right? Would you say HYG yielding 9%? I'm seeing 5.94. Am I off on that? I thought it was 9%. Is it HYG or is it LQD? Did I mess up? Somebody check that. Somebody fact check me. I could be wrong. See, I can make mistakes. Somebody fact check me. It's either HYG or LQD. Those are your corporate debt high yield indexes. So you have LQD, you have J and K junk bonds, and you have HYG. I thought it was HYG that had the highest yield. Somebody check for me. Because somebody on TikTok said it's only yielding 5.9. I'm pretty sure it's 9%. Anyways, check that out. Maybe I'm wrong. It's one of those. One of them is yielding 9%. People don't understand that one's thoughts on the market can change daily. Yeah, they can change. They can change daily, right? So you just think it through. No, LQD is at 4.124. So you take somebody's thoughts and you don't, the problem is people want people to think for them and make decisions for them. No, think for yourself. Take in all the opinions, make a choice for yourself, but educate yourself so you understand the literacy. Okay, I'm building a course from what I know to give literacy. Junk's at 6.84. Well, what the hell? Why is isn't HYG 5.9, bro? I could have sworn HYG was at 9%. I gotta look. Hold on. Let me look really quick. I don't see anybody else looking. Let me double check. Where's the HYG at? Oh, 30 okay, went down a little bit. 30-year day. Okay, so HYG it's the 30-day yield is at 8.9. It did fall. So it did fall. Thanks for fact checking. The 30-year yield. Now look, I could be making a mistake on this. I just saw yesterday 30-day yield for HYG was at 9%. Now it's at 8.9. So that's because as corporate bonds move higher, here's a lesson. As bonds move higher, as the debt of corporations move higher, or debt in general, as the bonds move up, the yield goes down. So you could have locked in 9% yesterday or before, but I still don't think that's the most attractive. That's for super ultra rich people because they got tens of millions of hundreds of millions of dollars that they don't need to use. So they're just going to get risk-free 9% on it, right? If you're looking for investments, that's not a good investment, to be honest with you. It could be in a portfolio. Everybody's situation is a little different, but I'm guessing most of you don't have $10 million or else you wouldn't be on TikTok, looking for financial channels on what's going on. So anyways, it's a 30-day yield, right? So if it's a 30-day yield at 9% or 8.9, then I think I'll have to look into that. Thanks for bringing that up. I have to look into how that actually works. But would you say J&K is at 6.84? And I'm looking on Robinhood. I could be wrong. I'm looking on Robinhood. 5.94. Yeah, that's what I got. I got 8.9. I'll look into it. I could be wrong. I make mistakes. I could be wrong about that. But I saw 9% on the 30-day yield, whatever that means. I'm guessing what it means is you take the yield, 30-day yield. How does that work? 30-day yield. And you're not getting 9% every 30 days. That'd be ridiculous. I think you divide it by 12. You have to divide it by 12, I think, and that's what you get. So I'll have to double check. Maybe I'm not sure about how that works. I'm not an expert on bonds, just understanding that, yields go up when the underlying collateral goes down, and then when collateral goes up, yields come down. But again, Bitcoin's up 100% on the year. You're not going to get that anywhere else, right? Not really. So that's the other part of it, why I'm like, do you really want to, especially with the Bitcoin ETF coming, do you really want to be in high yield anything? You could literally throw a tenth of your cash and it's going to still appreciate much higher than your 5% yield in Bitcoin, much higher. Do you have a specific schedule of which days you stream, or just whenever you feel like it? I need a schedule, Biggs. Usually what I do is I stream somewhere between 11:45 a.m., which is Eastern. I got to go with Eastern time, which is 2:40, somewhere between 2:45 a.m. and like 3:30. Not a.m. p.m. Eastern time. So somewhere between 2:45 p.m. Eastern time and 3:30 p.m. Eastern time. Kind of like 30 minutes. Just put it this way: somewhere between 30 minutes before the market closes. Usually like 30 minutes, because I'm either trading in the morning or I'm building content or doing something. So, I didn't get the Amazon call. No, I didn't. Big Man's coming. What up? So yeah, I'm streaming at some time in between that. Do I need a specific schedule? Kind of, but I don't really like to. I'm a freedom fighter. No, I'm just kidding. I don't really like to. No pun intended. I don't really like to put myself to an exact, because things change in the market so quickly. There could be something coming out at a different time. So usually it's when I feel like it, but typically it's going to be in the window between 2:45 or somewhere between an hour or 30 minutes before the market closes. What I would do is just hit the notification on YouTube. You'll get the notification, and I'm usually late. I'm black. I'm usually late by like 5 minutes, 10 minutes. You got to give us, black people are always late. I don't care if you say that's a stereotype. Well, duh, stereotypes, what do you think they exist for? Because they're kind of true, right? You got to own it. So yeah, that's what we're looking at. You ain't lying. Things can change. They change. So if there's an emergency meeting, then I'm going to be earlier, maybe later. Maybe there's more data coming in, so I have to delay it a little bit. So that's usually kind of what happens, or I run into some kind of issue. Anyways, let's get to I said like 10 times we're going to get to the actual, the data. I put this on Twitter, so we'll go ahead and look at this. What are we at? 146. The Fed is done hiking, I'm pretty sure. Let's switch to, let's look how crypto's doing really quick. Tesla's finally moving up. Bitcoin tried to make a big move to 35K. Wow. Yeah, Bitcoin tried to get to 35K. Link got up to 1132. Big capitulation. Ethereum 1850. It looks like, Ethereum is taking dominance. Ethereum is now moving. ETH to BTC is probably moving up. Yep, kind of. But it looks like Ethereum is leading right now. I'm sure there's some other altcoins leading, but Ethereum is now breaking out of this wedge. So you got Ethereum picking up. Chainlink is starting to capitulate. I know I'm always focused on Chainlink. Looks like Tesla could be bottoming if it gets above 200 and holds. I mean, this is your chance, right? I don't want to pressure people, but like every time Tesla goes oversold extremely and bounces with the overall market bouncing, all the bad news is kind of priced in, it's going higher. So for sure, Tesla, I think, reaches 230, 240, right? It could go up there and then sell off again. But for the most part, this should be a strong momentum move higher from Tesla, in my view. And what are some of the, there's more UAW. Actually, let's just get to the Twitter. It's all on Twitter. So there you go for what's going on there. Let's go to the Twitter really quick. That's where I put the information this morning. We're going to run through that. If you guys got questions, responses, let me know. All right. All right. So for Tesla, look, this is Tesla Chan. So far, who's capitulating, joining the NAC standard? This is the Tesla standard, right? Ford, GM, Rivian, Volvo, Polestar, Electrify America, don't even know what that is, Mercedes-Benz, Nissan, Honda, Acura, Jaguar, Hyundai, Kia, BMW, Mini, Rolls-Royce, Toyota, Lexus, now Subaru. What are they doing? They're all capitulating to the Tesla standard for supercharging networks, right? So they can monetize that. That's a potential monetization. So when the actual monetization comes, it's over. They're building infrastructure. The world's going to capitulate to that. What do we get this morning? I'll point this out really quick. Actually, I have this on mine. This is basically the Treasury issuance. It came in lower than expected, okay? You could check that out on my Twitter. I also put it right here. So Treasury issuance lower than expected. ADP employment payrolls lower than expected. Expected at 150K, they came in at 113K. So weaker private payrolls, right? That's why yields are easing. That's partly why. That's another reason why yields are starting to ease. And then you have the ISM. This was a big surprise to me. This kind of signals, honestly, I was like, no recession, no recession. Now I have to consider, did the UAW strikes contribute to the ISM falling? I don't know. Maybe it's not. I heard it's only about 9% of what could it be. So basically, supply chain managers are getting a little more bearish here, right? Which gets yields lower, which is why there's a very good possibility the market has a Santa Claus rally into the end of the year and then just sells off at the highs again, because now it's recession fears, growth is falling off. But again, I think then fiscal comes in. Here we go, printing more money, making sure there's no recession. So it's volatile. If anything, the market's going to be very volatile from what I see. Big moves up, big moves down. We don't paint no negative pictures here, positive outlooks. Yeah, it's always positive to some degree. The Inflation Reduction Act didn't reduce inflation. Vladimir sees. Oh, what up, Vladimir? You're back. Good to see you. Even Biden admitted. I never said the Inflation Reduction Act reduced inflation, by the way. Come back for a second round. Even Biden admitted $360 billion on green energy. Yeah, you're right. What up, Mike? Is that Mike? Is that Mike, the old Mike? I don't know. But yeah, Vladimir sees you. I don't know why you're mentioning that. I never said anything about Biden reducing inflation through the Inflation Reduction Act. If anything, it boosts Tesla stock. It boosts chips. Well, not chips, kind of. It boosts Tesla. Anything energy storage or anything renewable energy is going to boost. So it's going to boost asset prices at the end of the day and infrastructure build. But yeah, does it reduce inflation? No. What up, Mike? The only Mike. Okay, maybe that's the old Mike. It's just, Mike, you don't have a picture, a distinctive picture. Like Big Man's Coming, that dude got a distinctive picture. I don't even know what it is, but I recognize it. There's always something to put your... If Big Man's Coming changed his name, I'd still recognize him. I said inflation was down because of the IRA. Bruh, I never said inflation was down because of the Inflation Reduction Act. I said the economy is not going to fail because of the fiscal stimulus, which includes the Inflation Reduction Act, the CHIPS Act, and the infrastructure bill. I never said inflation is down because of the IRA. Inflation is, if I said anything that inflation is down, all I said was that CPI, the data is down. That's it. Those were your exact words. I'm sorry, bro. You heard wrong. If Tesla sustains this momentum, the target price is 221. Nice. Appreciate it, Carbides. I actually should bust out your technicals on there. So yeah, job openings were lower. Nobody cares. Private payrolls were lower. Why? Because Friday is the real employment data. Weak ISM, bonds go up. Good for stocks. Well, so far it has been good for stocks. So stocks kind of like the weakness right here. Here's the other part. Who's going to actually benefit? These are effective interest rates to the market right here in this effective interest rate. What does that mean? When you factor in what companies are paying versus the Fed funds rate, are their interest rate payments going up or down? Okay. Well, it looks like the bottom 50% of S&P 500, their interest rates are going up. That's why there is a recession. The rolling recession will continue, and it's very likely you see more defaults. And in certain areas, you're probably going to get more defaults. You're going to get a lot of companies really struggling. Okay. So a lot of the S&P is going to struggle because of this. A lot of small caps are going to struggle because their interest payments are actually higher. Middle 40% of S&P struggling, but the top 10%, their payments have went lower. The Mag 7 and plus some, they went lower, and they're pulling most of the revenue in the market anyway. So who's gonna actually benefit? Technology, industrials, anything has to do with fiscal policy, any companies who have more revenue, more demand, any companies who are increasing their margins to some degree, any companies who benefit from the gig economy, any companies who can invest cash in the money market funds and actually collect 5%, anybody who can get fixed income. Like rich people are going to keep the economy going because they can park 5% and collect that percent and keep spending. So that's why I don't see a recession. Okay. Anyways, that's one. Okay. Next, what else do we have? Oh, we talked about this earlier. The mutual funds stop selling. Market's going higher. Rates are easing following the weaker issuance. Yep, that's going higher. Bond inflows at record highs. Got to keep this in mind. All-time record inflows to bonds. Eventually, we're going to capitulate to the upside. We could be seeing. Listen, bonds could strengthen. Bonds could weaken tomorrow, possibly. what is it? It's Wednesday. We have 2 more days, but eventually, if the ISM continues to lag, bonds are going to explode. Bonds will explode and rates will collapse, and that means equities go higher, the good equities. Okay, what up, Gervain? Or Jervine Claire, I see you. Evidence of above potential GDP could warrant a hike. Need to see some slower growth, similar to today's ISM data and softening labor market. 100%, right on target, Jervain. Evidence of above potential GDP. And right now, GDP, like I said, the reason why I don't think rates go higher is because the fourth quarter GDP estimates dropped dramatically, right? Third quarter came in at 4.9%. Fourth quarter is coming in at 2.3%. That could change, but right now, GDP is not stronger. All right. But above trend growth, yeah, a little bit. But I think it's all about rate of change. So yes, I do agree with you 100% there. What else do we got here? Soft oil. This is the big upside. Soft oil, less risk to the market. Light issuance. We already talked about that. Light issuance. Bond shorts don't have to get too crazy. Peak yields. I think we're at peak yields. Fed is done. Earnings are positive. They're not amazing, but they're positive. They're getting better. We are in an earnings recession. That earnings recession is ending. In my view, global liquidity is picking up thanks to rates coming down and thanks to, by the way, liquidity picks up when rates fall, because if rates fall, collateral goes up. Collateral allows you to lend, so you have more liquidity, right? So right now, global liquidity should be picking up. The dollar is the last shoe to drop for the Santa Claus rally. To really, really start to ramp up. And when we look at the dollar, it did look at the dollar's still pretty elevated. Oh, shoot, you guys can't see that. My bad. Let me switch it. The dollar's still pretty elevated, so I'm a little worried about the dollar. It's up. Okay, so we'll see if the dollar can fall going forward. What do we got here? Mike V. AMD was great this week. Still holding my LLAP options till 2024. Oh, you got the LEAP options. Nice. If Tesla sustains this momentum, target price 221. We got that. Tesla does look juicy to get in, but I feel like it could go lower. Yeah, it could go lower. It's a possibility. It depends if those shorts are starting to cover, because you're going to get a rapid, move higher. If the overall market, if the Qs keep moving higher, then I don't see that happening. I need to move the camera a little bit. Hold on. There we go. So I think the Qs, if the Qs continue higher, we're good. Dollar's still pretty elevated though, goodness sake, and it moved up before the meeting. So this is weird. Now the dollar is actually stronger than, I would say stronger than bonds or rates. And this, we haven't seen this. Typically when rates fall, the dollar does fall. So I don't know. The dollar's not showing peak dollar, but rates are showing peak rates. We'll see if how this plays out going forward. So yeah, I think Tesla goes up as long as the Qs can continue the recovery. Pretty sharp rally for the Qs here. But Tesla is lagging. I will be honest. Tesla's lagging a little bit, and I don't like that. I don't like that when it comes to Tesla. It is showing some lags, and that's the case we're seeing. Ethereum pretty strong. Palantir probably has some good upside. KRE, did KRE recover? This is the regional banks. I don't think so. All right. Well, hey, you guys got any questions? I think we covered everything. I think we pretty much covered everything. Stay tuned. Tomorrow we have Apple earnings. We got Apple earnings, and what else is it that we have tomorrow? What am I missing here? I think we talked about this yesterday. Apple earnings. Oh, and Gary Gensler, bro, he had a cryptic message. He said, if Satoshi, this is Gary Gensler. This is the SEC guy, right? Who has basically been halting crypto from Bitcoin from becoming a commodity. He says, if Satoshi Nakamoto went as Satoshi Nakamoto for Halloween, would we be able to tell? What kind of cryptic message is that? Happy 15th anniversary to Satoshi's famous white paper that started crypto. So he's cheering on crypto here. Any crypto companies that are tricking investors should start treating them to compliance with the securities laws. Are we closer to a Bitcoin ETF? That's the question there. Gary Gensler sounds kind of bullish, right? He's over there congratulating Satoshi Nakamoto. What does that even mean? If Satoshi Nakamoto went as Satoshi Nakamoto for Halloween, would we be able to tell? That's a really cryptic message coming from a guy everybody wants to see turn and flip. Also, the negative news on Tesla for on semiconductor, bro, that was like 10% of their batteries over in Japan. So that had nothing to do with Tesla. Plus, they finally won a suit, a 4-year suit in California. There's a guy who was drunk. Well, I don't want to say he was drunk, but basically they proved that full self-driving wasn't the reason for the crash, and that was 4 years ago. The guy had a couple drinks, and he turned the wheel 45 degrees. Full self-driving doesn't do that. He wrecked. Unfortunately, he died. Condolences. But, Tesla won that suit, so that's another positive step forward, meaning they're, the FUD against Tesla's full self-driving is disappearing slowly. Yes, Tesla looks juicy. I do agree. So yeah, I think that's what we have. Let me see on the economic calendar. ISM manufacturing tomorrow. We have, dude, am I tripping? I might be tripping today. No, I'm not. Tomorrow, we don't have much data, do we? Non-farm payrolls, jobless claims. Those have been pretty strong. We get China ISM numbers, factory orders. Tomorrow's all technicals, it looks like. Unit labor costs might be a big catalyst. Are they slowing down as unit labor costs? That's productivity. Or is productivity picking up? What else we got? I came late. What happened? Okay, Slime Z, is a Santa Claus rally. Is this a Santa Claus rally? Yes, it is. We still have 2 more days, though. We have tomorrow, which is all technical. I think tomorrow we trade higher. All right, Slime Z, I'm going to finish off with you, all right, because you're late. You're one of the day ones, so I don't mind restarting here. All right, so let's check this out. We had the Fed meeting today. What did he say? Absolutely nothing, because it's nothing we didn't already anticipate. The Fed is communicating beforehand and telling us what we want to see. What we had early is the dollar start to move up, and I was like, oh shit, the dollar's moving up. What's going on? Are rates moving up? No, rates actually fell. So why are rates, which is the big headwind for stocks, why are rates falling? The 10 years, let's just go to the 10 years, since somebody cried about it yesterday and said, the 10 year is the one you got to watch. I agree. But either way, rates, we got to watch rates all around and see if something's changing. So the 10-year dropped, okay, right after the Fed meeting. Why? Rates have likely peaked because the Fed is done. The Fed has paused. He said nothing about going higher, number one. Number two, congratulations on your license. Dang, bro, that's crazy. You just got your driver's license, man. If I was your age, oh my God, I'd be buying so much crypto and just waiting. I would just buy so much crypto if I was your age. And just wait. Let's see. So what is the main thing? Oh, also, so Slime Z, we also had treasury issuance today. The announcement for was it the guidance? Let me say this correctly. It was weaker issuance expectations. So the Treasury basically announced how much issuance, how much Treasury issuance, how many bonds, how much debt they're going to actually put on the market. They announced that they're going to be done issuing debt, and maybe they change, but for now they're going to be done issuing debt by Q1 of 2024. So March, they're done. Okay, no more debt after March. That's still a lot. That's 1.5 trillion of debt to come onto the market. The positive is the expectation of debt is actually lower than what it was, right? The other positive is they're going to be targeting, and I got to double check this, they're going to be targeting the short end of the curve, which can be sucked up or absorbed by Fed liquidity, shadow QE, right? We have the reverse repo. Shadow QE is coming in buying up the short-term treasuries. So that's the positive there. So the Fed is done. Rates are coming down. Also, ISM, here's the good, bad news. The ISM survey, the manufacturing, I always say this leads the business cycle. It almost got above, I thought it was going to go above 50. It got to 49. So you're taking employment, productivity. The most important segments are prices paid. So how much are manufacturing paying prices to run their businesses? You don't want those to go higher. They did go lower. New orders leads everything. How many new orders are you getting? Those fell dramatically. So really forward-looking manufacturing growth just fell. Okay, not good for the economy, but good for rates. Which, what do you think the market cares about? Well, most of the market's going to be stagnant, but when it comes to the Mag 7, I mean, they're already making revenue, so lower rates is going to be bullish for the Mag 7. So new orders came down. Forward-looking growth for GDP is down, but we already know that GDP is down. Rates come down, right? What else did we get? We got jobs. ADP private payrolls down. Missed expectations, rates come down. Another reason for rates to come down. Easing rates. So that becomes now if rates keep falling, that's going to be a headwind. I'm sorry, it's going to be a tailwind for risk assets, the premium risk assets, not all of them. Weaker issuance expectations, rates down. Weaker jobs, rates down. Weaker ISM, rates down. We also showed a record inflow of bonds. This will be on the newsletter too. If you guys want to subscribe, newsletter link in the bio, link in the description. There's a newsletter, weekly newsletter, tells you what I'm looking at, what I'm mostly focused on, to give you a bird's eye view on the macro and some technicals and some fundamentals at the same time. You want to pay attention because I'm getting the fundamental reports that end each week and telling you where earnings at, where the fundamentals starting to look like. So check that out. Newsletter is free right now. It's not always going to be free, so do it while you can. Get it while you can. Anyways, there's an all-time record high of bond inflow, so a lot of inflows of U.S. bonds. What does that do? That pressures rates lower. We already saw that bearish divergence. So look at this bullish divergence on bonds. You got an all-time high record inflow. Look at them move up. The buying pressure is moving up. Are bonds breaking out? Whew, sure does look like it. If those break out, rates come falling down. If rates come falling down, dollar comes down. If dollar comes down and rates are down, S&P explodes higher. We probably get to the top of the range, and then it's going to come down to other factors. Actually, this could be it. We could just be chugging higher from here. Look at the VIX. VIX down, back below 20. Risk on, right? Equal weights, they do suck because, a lot of them are exposed to high rates already. So equal weight kind of sucks. What else are we missing here? I think that's it, bro. Earnings are pretty positive. We're going to be looking at Apple earnings tomorrow. Those are the big earnings. Apple earnings will probably be a huge major factor. It's the size of the Russell. So stay tuned to Apple earnings tomorrow. And then Friday's the employment report. So yeah, that's it, bro. That's what we're looking at. If we look back, global liquidity is going to be up also. So yeah, we got the market ripping higher. That's all I got for you guys. Appreciate you guys joining for the live. Don't forget to like, subscribe, hit the likes, help me out in the algorithm if you don't mind. If you don't like me, cool, hit the thumbs down. Anyways, I appreciate you guys as always. Stay blessed, get your workout, stay healthy, always improve, always get better, and we'll catch you guys next time on another episode of Debate Me on the Market. Thank you. No, I'm just kidding. All right, YouTube, check you guys later.